Good evening. Thank you for joining the CUHK Business Webinar Series. I'm Anson Au Yeung, a Senior Lecturer at the Department of Finance and the Program Co-Director of Asian Business Studies. Tonight, I'm going to talk about oil ETF. Let me show you the first slides to motivate our studies. In these slides, I try to plot out the recent oil price movement and also the trading volume of the oil ETF together. We all know because of the outbreak of the COVID-19 virus, many people are forced to stay at home. And as a result, the demand of the oil drops significantly. So if you see the solid line represents the spot oil prices. It drops a lot because of this weak demand. But on the other hand, if you look at the shaded area, this is the trading volume of the oil ETF. We do see many investors in this market, they try to speculate for the oil rebound. So you will see there was huge flows of the funds to these ETF instruments. However, I do observe an issue. The issue is many retail investors, they mistakenly believe investing in these oil ETFs is equivalent to investing in the oil. But this is not the case. Unlike the gold and the equity ETFs, they are backed by physical assets. So for the ETF issuers, for the oil ETF issuers, they don't have the facilities to store the oil. So that's why they need to use some paper contract, such as the futures contract, in order to help the investor to attain the investment exposure. Now, to be exact, I can describe for those oil ETF investors, they are actually buying something so-called the futures-based ETF. When an investor buying this futures-based ETF, they need to beware of two important risk factors. The first factor is there is an impact of rolling the futures positions. What do you mean by the rolling of the futures position? Now, let's imagine if you buy the physical oil, you can just buy and then store in the facilities and then hold it for 5 or 10 years. But for the futures contract, it has an expiry date. So for these ETF issuers, once the futures contract expires, then you need to roll over this futures contract. Now, of course, when they try to roll this futures contract, it will have some impact on the ETF return. And second, the investor also need to beware of the sudden changes in the investment policy. So later on, I will elaborate more on these 2 points. Now, let me visualize the impact to you. So what I did is, I tried to pick out 2 examples. One is the USO. USO is the largest oil ETF in the United States. And the other one is the Samsung Crude Oil ETF, 3175. So we can trade this in the Hong Kong stock market. So my exercise is, I try to put $100 for these 2 ETFs since inception, and then hold it until today, and then I try to look at what will be my return. So you will see, for the USO ETF, you are going to lose more than 90%. And for the Samsung Crude Oil ETF, when you just buy at the beginning and hold it until today, you are going to lose more than 80%. So the message here is, these oil ETF instruments are not designed for long-term investments. How about short-term? As I mentioned, many investors, they want to speculate for the oil rebound. So can we use this to take advantage of the short-run rebound? So I show you the second graph here. So this is a second graph. I try to shorten the time frame. I try to look at the relative performance of these oil ETF and the oil price. So you will see for the USO, although it rebounded, but it cannot follow the exact magnitude of the spot oil prices. And for the 3175, the Samsung crude oil ETF, so the rebound magnitude is not as good as the spot oil. Now, right now, then we can ask the questions, what's going on in the oil ETF? Now, to answer these questions, we need to understand what the investors are investing. Now, in the oil market, actually, we have two important benchmarks. One is the Brent oil. The other is the WTI. For the WTI represents the West Texas Intermediate. So the major oil actually produced in the United States. And then once it is extracted from the oil wells in the United States, and then it will be transported via the pipeline to a place called Cushing, Oklahoma. Now, in terms of the quality of this oil, we can describe this as very light and sweet. So what is light and what is sweet? Sweet means, this oil contains very low sulfur content. And very light means, this oil has a density that is lower than the water. And it has an API gravity of very high. So I can tell you, for a low sulfur content and a lower density, it means, this oil have a perfect quality for fuel refinement. How about the Brent oil? So the Brent oil actually extracted from the North Seas. And once the oil is extracted from the ocean, it will be transported via the oil super tank to the rest of the world. Now, if we compare the quality of the Brent and the WTI oil, so the quality of the Brent is actually not as good as the WTI, because for the Brent oil, it has a larger or greater sulfur content, and it is also not as light as the WTI oil. Now, however, if we compare the price of the Brent and the WTI oil, so there's a difference. So although the Brent oil is not as good as the WTI, but the price of the Brent oil is always higher than the WTI. Now, why this is the case? Because of the transportation cost. So for the WTI oil, because it is a landlocked transportation, using these pipeline facilities, the transportation cost would be higher. So after accounting for this transportation cost, so the selling price would be lower. Now, so once we understand, the crude oil market, so the next one is we need to look at the futures contract. Now, why we need to look at the futures contract? Because for a typical investor, it is impossible for us to buy the crude oil because we don't have the facilities to store the oil, right? So that's why, now we need some paper instrument, the futures contract, to help us to achieve this exposure. Now, in this table, particularly I want to highlight this WTI futures contract. So what is futures contract? Futures contract basically just saying the two parties, they want to agree buying and selling the crude oil in the future. So for this WTI contract, if you buy one contract, that means the other side is going to deliver to you 1,000 barrels of the crude oil in the future. Now, why I highlight this? Because for the two examples that I mentioned, the USO and also the 3175, so these two ETFs track the performance of the WTI futures. That's why, now we need to understand this. Now, another question is, a lot of the people, they don't understand why the futures price dropped to the negative price for the first time in history. Now, if you look at the WTI, there's a table here. When we check the settlement method, the WTI will be settled physically. So we know a lot of the investors, they just want to speculate for the oil rebound. They don't have the intention to hold the oil. So if you force them to physically settle the oil, that may not be possible. So that's why many investors, before the expiry date, they are going to sell or dump this futures contract. So that's why now the price dropped into the negative price in the history. Now, after we know now what is the basics of the futures, how can we set the futures price? So let's imagine if we I want to sign a contract to you. We want to agree the futures price of the oil, let's say 1 month later. So how can we determine this price? Now, to determine this price, we can use a very simple trick. The trick is what? The trick is I can borrow some money, and then I use this money to buy the oils in the market. And then I store this oil for 1 month, and then right after 1 month, I can deliver the oil to you. That's why now if you look at the formula right here, so how can we determine the futures price? So the futures price can be determined by the spot price, the present price of the oil, plus the interest cost, plus the storage cost, and minus some convenience yield. If we got some physical oil, that may be convenient to us, so we can have some benefit of having some immediate oil. Now, to understand now what's going on, you need to also know one more technical terms. This technical term is a so-called the contango and also the backwardation. Now, so what is this? Now, because for the futures contract, it has different time to the maturity. So what I'm trying to do here is we try to plot out the so-called the term structure. So for different maturity contract, I try to plot out the price. Now, you will see, now, if the futures prices are higher than the present price, so we call this a contango. So this contango means the market, they may expect in the futures, the oil price may goes up. Now, on the other hand, we have a term so-called the backwardation. So backwardation means the future prices is decreases with the maturity. So if you look at the graph here for the backwardation, if we plot out this term structure, the farther the contract, the prices will be lower. So you may interpret this as the market may think of the oil price will drop in the future. Now, up to this point, let me ask you one question. So do you think for this oil market, is it behave in a contango or at the backwardation? Now, let me show you the answers. Now, the answers is most of the time, contango prevails. So in this graph, what I did is I tried to do one exercise. The exercise is I try to use the longer the maturity contract, the price, and then minus the nearby contract. So if it is at the contango pattern, what will happen? We will have a positive spread, right? Because the futures price is higher, and then we minus the lower price right now, so we will have a positive spread. If it is at the backwardation, it's just the flip, right? We use the lower price in the future and then minus the higher price recently, so we have a negative spread. Now, if you look at the graph here, you will see most of the time the spread is positive. The spread is positive. That means what? That means most of the time the oil futures, they are trading at a contango pattern. The futures prices are higher than the spot prices. Now, this is a very, very important point. Now, let me use some numbers to illustrate to you what is the impact. Okay? So if we know what is contango, so what will be the consequence or implications behind the contango? Let me use some simple numbers to show you. Now, in this case, let's imagine we have an ETF fund. They start with the position of $100 in March. And then this contract will be expire in April. Now, so near April, so we need to roll over this contract, right? Because this contract is going to expire in April. So what this fund is doing is they try to roll over this to the next nearby contract, the second contract. But for the second contract, because of the contango pattern, the futures prices is higher than the present price. So just like in our example here, so you see, in April, the second contract, the price is 113, and for the first contract in April, the price is 110. So when you do this rollover, you have to sell this at 110 and then buy this at 113. So with this transaction, it would incur a so-called negative roll yield of -3. Okay, you will have a -3 negative roll yield because you try to sell this at 110 and then buy this at 113. Now let's say this ETF continue to run in May. So in May, the position stop at 115. So remember, we start at 100 and then we end up at 115. So let's imagine if we don't need to do this rollover, so how large would be the profit? The profit will be $15, right? 115 minus 100, you got a $15 profit. However, because in April, the contract expire, we need to do this rollover. So we incurred a -3 negative roll yield. So the profit will be smaller, okay? It will become 12 instead of 15. Now, right now you understand the consequence of this negative roll yield. How large will be this effect in reality? Let me show you one more graph. Now, for this graph, what I did is I tried to do a simulation. So I just imagine myself try to buy this futures contract since 2006. And then for every single month, I try to do this rollover, okay? Do this rollover exercise. So you will see, okay, for the shaded area, this is the cumulative roll yield, okay? Cumulative roll yield. So for every single rollover, I try to calculate the negative roll yield. And then in another month, I also calculate another roll yield. And then I accumulate this, okay, together until today. Now, so you will see, okay, now the cumulative roll yield impact is very, very significant, very significant. So you will see, okay, now, if we don't need to do this rollover, so the profit will be this orange line. But if after we consider, okay, this negative roll yield, actually the cumulative profit will be smaller. You can see this, okay, from this solid blue line. So don't overlook this rollover. So after this, you would understand now the beginning slides, right? So these oil ETF investment are not good for long-term investment, right? Because the cumulative roll yield, the effect is very, very significant. Now, how about the short run? So I want to show you other things. The other thing is how this term structure behave during this turbulence time. Now we know recently, okay, there's a lot of the uncertainty. So the volatility in this market also goes up quite a lot, right? So although we understand for this oil's futures market, they are trading at the contango. So if you look at the graph here, so in the normal days, the term structure is not very steep, okay? It's not very steep. But during the time of the uncertainty, so those market investors, they will demand what? They will demand a higher risk premium. After accounting for this higher risk premium, under the uncertainty times, the term structure will be widened. Now, so because of this, when the ETF issuers, they do the roll, they need to sell low and buy high, right? So in the normal days, they just need to sell low and buy at the relatively higher price. But in the uncertain time, they have to sell low and then buy at the even higher prices. So the negative roll yield effect is much more severe during the uncertainty time. Now, if you don't believe me, I give you some actual evidence. Now, for this graph here, I just plot out the term structure in February and also in March. So the blue line is the term structure in February, and this purple line is the term structure in March. You may not aware, okay, there's only a slightly contango pattern. The futures prices is just slightly higher than the present price. So in the normal days, if the issuer do this rollover, the negative roll yield impact is just minimum. Now, let me show you another chart. So this chart shows you just a few days before the negative futures oil prices. Now, so you will see, okay, just a few days before that, because before this historical event, the market is very, very volatile. So as I mentioned to you, the investor in this market, they will demand a higher risk premium. So you will see, okay, now if you look at the term structure, just a few days before this historical event, the term structure is very, very, very steep. Okay? So very steep, again, okay, it means the negative roll yield impact is very high during this period. Now, so right now, you have sufficient evidence or understanding to know about, okay, the impact of the futures rollover. Now remember the second potential risk. The second potential risk is the investor need to beware of what? Beware of the sudden changes in the investment policies. Now, when I try to check the announcement from the website, I do see for the USO and also for the Samsung crude oil ETF, they try to amend some investment policy recently. So for example, for the USO and the 3175, they try to further roll this into a further period. So in the normal days, usually, okay, they just roll over this contract to the next nearby month. But in the recent, okay, period, they try to roll this further on. And next, these two ETFs, they also try to stop issuing the new units. They stop issuing the new units. Now, let me explain, okay, now, how the changes in this investment policy would also affect the investor return. Now, to understand, okay, the first one, rolling to a further position, right? So in the normal days, as I said, for the USO, they usually just roll over 80% of the money in the nearby contract and 20% of the money in the next nearby contract. But in the recent period, they try to roll this even further. So when I check the numbers, in the April, they try to roll this to June, July, August, September, even up to December, okay? So once again, if the ETF try to roll to a further period because of the contango during this uncertain time, the term spread is actually much higher. So if you roll this further, these ETF would also suffer from a higher negative roll yield. Now, another point is a lot of the investors, they may miss this. It's about these ETF, they try to stop issuing new units. Now, when I check the announcement, so I do see on April 21st, so USO filed an announcement to the SEC, and then they try to stop issuing the new units. So what does that mean? Now, in the normal days, when more investors want to invest in these ETF funds, when more money comes, these issuers, they will issue more new units to satisfy of this sudden increase of the demand. But right after April 21st, they stopped doing this practice. So that means for the investor, if you want to buy these funds, you just need to buy the units from the existing market. The issuer, they won't issue any new units after April 21st. What will be the impact of this? Now, the impact of this can be shown by this graph. Now, if you look at the graph here, you will see we have a dashed line. So this dashed line, would be the date of the April 21st. So on the left-hand side, this is the period before this April 21st. And on the right-hand side, this is the period after April 21st. So what I'm trying to do is, I try to look at the price to the net asset value of this fund. I try to calculate the ratio on this. So before that, this USO can still issuing the new units. So you will see most of the time, this is at the negative region. A negative region means, now we have a price to the NAV discount. A price to the NAV discount means, the investor, you can use a smaller amount of the money to buy a higher net worth of this ETF. But after April 21st, the things flipped. If you look at the right-hand side here, when they stop issuing this new unit, this ETF is going to trade at the price to NAV premium. So a price to NAV premium means the investor, if you want to buy this ETF, you need to pay a higher premium price to buy the net worth of these ETF shares. Now, of course, now for this premium, it is at a disadvantage for the investor because you need to use a higher price to buy a lower net worth. Now, so to wrap up, today we want to understand what's going on in this ETF. In particular, I highlight two potential risk factors for you. If you want to invest in this oil ETF, remember the two important risk factors. The first one is the impact of the futures rolling. Now, don't overlook this futures rolling. If you accumulate this negative impact of the futures rolling for a long time, the impact can be very, very significant. And second, you also need to pay attention to the sudden changes in the investment policy, because tiny changes in the investment policy will also affect your investment return. So, thank you very much. Now, this is the time for the Q&A. If you have the Q&A questions, you can make good use of the Q&A function. Okay, so in the second question, could you please explain how to infer the futures price formula? Now let me get back to that slide and then show this to you again. Now to determine the price, the logic is very simple. The logic is So I use an example. The example is we too want to agree the price in the future, right? In the future. So let's say if you want to buy some oil from me and I need to deliver this oil to you 1 month later, right? 1 month later. So how can I set the price? How can I set the price? To set the price, what I did is I can just borrow some money from the market and then use this money to buy the oil right now, and then I store this for 1 month. After 1 month, I can sell this oil to you. So what is the cost for me to do this strategy? The cost would be the interest expenses, right? Because I borrow some money, right? I use this money to buy some oil, the cost of the oil right now. And I also need to consider the storage costs, right? So for simplicity, you can just think of the futures price of the oil is equal to the price today plus the interest cost and also plus the storage cost. Because the interest cost and the storage cost is high. So that's why, okay, you will see most of the time the futures prices is higher than the present price. Okay. Any more questions? Okay, so question 3. So how to know which oil stocks are good from the chart? Okay, are good from the chart. Okay. I've prepared this for you. Now, if you ask me, I tend not to give investment advice because it is not too good to give investment advice here. But actually, okay, I did, okay, one exercise. The exercise is a lot of the investors, they just want to speculate for the oil rebound. But there was a risk here because for the USO, this oil is tracked with the WTI futures. And for this WTI futures, it will have a possibility that this futures will go into the negative price, right? So that will be quite dangerous, actually. So I think, okay, what we can do is, why don't we look at pairs of the oil? For the Brent futures, because they don't need to physically settle. So for the Brent oil, it is not very likely or possible to drop into the negative region, okay? To drop in the negative region. So what I did is, okay, why don't we just buy the Brent oil and then we short the WTI oils? And if you look at the chart here, I do, okay, a very simple experiment. Just a look at the gross spread, the return of the Brent minus this WTI oils before the transaction cost. I don't take into the consideration of the transaction cost. But you will see, okay, now most of the time the spread is positive. The spread is positive. So I think, okay, it would be much more safer, okay, when the WTI futures drop into the negative. If you short sell this, okay, you can protect yourself. But it would be not likely for the Brent oil to drop into the negative price. Next questions. How about if the oil future price is in backwardation? Is it good to invest in such oil ETFs? Now, good point. The answer is theoretically, okay, is yes. Because when the oil price is at the backwardation, that means, okay, for every, okay, rollover of the futures, you will have a positive roll yield. So if you can accumulate this positive roll yield, so investing in this ETF, okay, the increase, okay, the performance may be better than the futures. Now, but I want to take a warning of this, okay? Backwardation doesn't mean, okay, you can make a profit, because ultimately, this oil ETF tracks the oil performance. If the oil price, okay, drop, even though it is in a backwardation, you can still cannot make a very decent profit. Any? Oh, yes. So question 5, So why is the price negative? Now, I think you are asking about why the futures price is negative, okay, at that time. Now, let me go back, okay, to that slides. Now, to understand why the price becomes negative, you need to look at the settlement method of the WTI futures. For the WTI futures, the settlement method will be physically settled. Physically settled means, now if you buy the futures contract, so at the maturity, your counterparty would deliver you the oil, okay? You deliver you the oil. So if you are the investor, you need to do what? You need to find some places to store the oil, right? Now, of course, for a typical normal investor, we don't have the facilities to store the oil. So what can you do? You need to get rid of this before the contract expires. Because if you don't get rid of this, once the contract expires, you actually need to use your money to buy the oil, right? So at that time, when many people try to sell this before the maturity, so that's why the price would become very negative. Now let me give you more evidence on this. So the evidence is you need to look at the storage capacity of the oil. So what I check is, now for the WTI, because the WTI oil is based in the US, and then okay, the storage facilities are at where? Are at the Cushing, Oklahoma, right? Cushing, Oklahoma. But for a typical retail investor, you will not be able to get any access of these storage facilities. Because for these storage facilities, you need to sign a very long-term contract. So it is impossible for you to get these long-term storage services. So that's why you must get rid of this oil. And on the other hand, now we can also check the price level of this oil tanker. Before that, the price was low. But in April, the price become suddenly very high. Yeah. So these oil tankers are also full. So it's impossible for us to find any storage facilities. That's why everyone need to get rid of this oil before the maturity. Now I still have one more slide to elaborate this point further. Now this slide elaborate more during that historical date. That day, the oil price really dropped into the negative region. So what I did is I tried to look at every single second what happened to this futures price. Actually, this futures price only comes into the negative for only a very, very short time frame. So they are going to settle around here. So before that, because suddenly people want to get rid of this, they try to sell it. So the price dropped into the negative region. But after that, after this settlement, the price immediately go back into the positive region. Yeah, question 6. So can you explain a bit more about the rollover effect? Is it the longer the period, the more significant the rollover? Okay, so I can use this to explain more about this rollover effect. Now, what the ETFs they are doing, they need to do a strategy, so-called the stack and roll the futures. Stack and roll the futures. Remember, for these issuers, they have to buy the futures contract, but this futures contract has an expiry date, right? Now, for this graph here, now let me show you. Now, let's say if we don't need to do any rollover, so you can just buy here, and then in the futures you sell here, right? So let's say, imagine the price, okay, didn't move, the price didn't move, so what will be your return? Your return would be 0 because you buy at this price and then you sell at the same price in the future, right? In the future. So the return is 0. Now, how about, okay, if we need to do this rollover? If we need to do this rollover, because of what? Because of the contango pattern. The futures prices are higher than the price for today, right? So when you do this roll, you have to sell low and then buy high, right? Sell low and buy high. So again, let's imagine the price, okay, didn't move, okay, didn't move. But for every single round, if you sell low and buy high, sell low and buy high, sell low and buy high, sell low and buy high. So the cumulative negative impact would be very, very, very high. The last questions, okay? Now let me look at the last question. The last question is, if the oil futures prices only depends on the spot, interest, and storage costs, how does it take into the account the price of the oil falling? Now, good questions. Now, that formula only shows you the relationship between the futures and also the spot price, right? But for the spot price, it is related to what? It is linked to the fundamental of the economy, right? So the oil price can be depends on what? Depends on the market condition. So in the recent time, because of the weak market demand, so the spot price also dropped quite a lot. Now, and for the oil also depends on other factors, such as the political factors. If the political tension becomes higher, there will be also some impact on the spot price. So my point is that equation just tells you if you want to determine the futures price, you can use the spot price plus the interest plus the storage cost to agree on this futures price. But the price would depend on the market condition. When the market condition changes, so the price will also change. Okay? Now, thank you very much, okay, for your questions, okay? Now, once again, I would like to thank you for joining this CUHK business webinar. I hope you can learn something about the oil ETF. Thank you very much.